Good afternoon, everyone. Today is Friday. It's the 17th of May, 2013, and this is Brian Shannon from AlphaTrends.net. We had another great week for equities, and the things in downtrends continue to move lower, such as gold and silver. S&P 500 up 2% this week, financials up 3%, and real close to that $20 level we've been focused on for the last several months. If you look at the analysis I've been doing since you've been watching me on YouTube or wherever it is, and in particular this year, I've been very consistent about my message that this market is an uptrend. It's innocent till proven guilty. There are levels above that we wanted to look at as potential resistance, but it didn't make sense to sell or sell short because we thought there was a triple top or whatever other people are talking about. It hasn't made sense to sell because the volume has diminished as this market rallies. And you know, you look at it, the market, the 20-day moving average of volume is heading lower once again as this market rallies. So there will be people that say this market can't sustain itself, and you know what, that's pretty much common sense. It can't sustain this type of pace for a long time, but while we have it in a primary uptrend like we have, we need to maintain a consistent, disciplined, objective approach based on what the price action is telling us, and that's what I've been able to provide each and every week, and that's why I think you tune in. The market this week, the S&P 500, we were talking actually about it holding up above about 162.35 was going to be our key level that we wanted to see hold. That would have been right here. Well, again, we have a rising 5-day moving average, and we've been raising those levels each day in the aftermarket videos that I do for the subscribers. So there's no way to tell where the top will be on this thing. We could gap down to 164.5 on Monday, let's say, and I'm not predicting that. I'm laying out a scenario that potentially could happen. And what would be the worst that could happen at this point? That you give back some of your profits. You have to have a disciplined, objective, and consistent approach. And I'm going to remain bullish as long as the market tells me to. When we break below intermediate term levels of support next week, that'll be this area in here should be our band of support at about 164.5 up to 165.25. If we break below there, then I'll get a little bit more cautious and think maybe we're going to pull back down to the 20-day moving average, or we could look at some Fibonacci off of this recent rally and say where would a 38.2% retracement take us to about 162. A 50% retracement would bring us down close to closing that gap at 160, and we would still be in a primary uptrend on the daily and weekly time frame if we were to get such a pullback. So our job is to continue to listen to the message of the market, to be objective, to say yes, this type of rally often does experience a deeper pullback, but we continue to make higher highs and higher lows, so our focus should be on the long side, managing risk and finding the low risk, high potential trades. Last week I had mentioned this CME and that I thought it still had the potential to go. Well, buying right here with a stop below this level, the stock continues to rally, and there are dozens of stocks that set up like this each day. Maybe not every day, that might be a slight exaggeration, but there's a good stock in this PRKR that we've been involved in that has a massive short position and a great longer term chart. So you know, stocks like Tesla, obviously it came close to that $100 level this week. It continues to make life torturous for people who fight the primary trend. Tesla has been above this rising 5-day moving average this entire rally. So is the S&P 500. We had one little close below it over here. A bunch of people freaked out, but from that failed breakdown came this fast move higher. So, you know, if we get a pullback, it shouldn't become a surprise. It shouldn't be a surprise. Prudence says you take a little bit of profits along the way. You rotate out of those stocks that are starting to pull back and make the lower highs and lower lows, and you avoid the garbage that's in a downtrend, garbage like gold. Gold is in a primary downtrend. We spoke about this right before it broke down, as it broke down, saying that it's guilty till proven innocent. This is the lowest weekly close, at least, that we've seen in several years. And, you know, the path of least resistance is lower. We spoke about how, yeah, it's going to get a bounce, just like Apple has had bounces in its primary downtrend, but the trend remains lower in Apple. We'll talk more about that in a moment after we go through the indices. The Nasdaq, another new high for the year in this market, and yes, it's getting extended, but what are the key levels? Where do we want to see this market hold? This market, the Nasdaq, has held that rising 5-day moving average the entire time. So perhaps it's going to take a close below that and some of this little resistance. Let's go down to a 10-minute time frame. That this little resistance area between green here, so that this might be our important near-term band of support next week, 73 and a quarter to 73.75. If we break below that, the 5-day moving average starts to head sideways and then lower. Well, then you would expect that the market will pull back somewhat within this primary uptrend, and that if you're trading, that you should move to the sidelines on those stocks. And then when you look at short candidates, look at the stocks that are in downtrends. Look at stuff like gold. It's in a downtrend, and after it exhausts itself on the way up, the 5-day moving average turns lower and it breaks support. Well, the sellers come back in. This is a stage 1 accumulation, stage 2 uptrend, stage 3 distribution, and stage 4 decline on this 30-minute time frame that holds 35 days worth of data, which is in alignment with the daily trend, which is lower highs and lower lows, and the weekly time frame, lower highs and lower lows. Gold could head down to 100. I don't know. I don't have any particular interest in it. I don't even like to trade gold because these gaps every single day make it a crap shot when you walk in. But let's continue to focus on the equities markets. The Russell 2000, as we know, broke important resistance at about that 95 level a couple weeks ago and continues to blast out to all-time high territory. And again, I still get every single day, I get the argument saying that this is ridiculous and unfounded and it's only because of the Fed. And great, what difference does it matter why? We don't get paid to intellectualize and listen and try to understand why. Our job is to listen to the message of the market and to manage risk. You can write essays and teach a college course if you want on economic theory and policy, but that really doesn't help a whole lot in the equities markets. If the trend is higher and we hold above key levels of support, then we're innocent until proven guilty. Next week, I'd like to see 97.5 hold in the Russell 2000, and near term, I guess that these lows in here today, which were a little bit of resistance on Wednesday and Thursday, I'd like to see that hold as a first level at about 99.5. The semiconductors are continuing to rally up towards that $40 level. They had really more of a consolidative week, I guess, in here. But if you look at this percentage, we were still up for the week in the semiconductors. So what does that tell me about this market? For now, it says, well, maybe it's getting tired. Well, maybe it's not. Maybe it's just resting before it runs another fast lap around the track. Or is it going to burn out and fall? Well, what we want to do is we want to maintain focus on about the 38.20 level. If 38.20 breaks and it holds below that, then I would say what we want to do is look for intermediate term levels that it could pull back down towards. So perhaps a 38% retracement, maybe a 50% retracement down at 36.5. But the trend remains higher. Consolidations remain innocent till proven guilty, and they're more likely to continue than they are to reverse. We're correcting through time, which is bullish. A price pullback is still bullish, but we have to wait for the momentum to resume to the upside again before we say, okay, well, what's next to the upside? And if you're positioned in here, your job at this point remains the same. It's always the same, regardless of whether it's an election year, whether the Fed is meeting, whether something's going on in Europe, or if North Korea says they're going to nuke us or sequester, or any of that stuff. Actually, go back and ask yourself, has listening to the news helped or hurt you in the market this year? I would bet if you were honest, you would say it's probably hurt you, because price action continues to climb this wall of worry, and we have the financials that today hit a high of 1996, closed at that 1995. How many weeks have I been talking about this? How many months have I been talking about this market being gravitated up towards this $20 level? Well, we're basically there right now. And guess what? It's not showing any signs of slowing down. This week we saw that there was good support found at that rising 5-day moving average at the $19.10 level. It then broke out past that 1930 level and continued to make higher highs and higher lows. Our first important level for next week will be about $19.60. If that fails to hold, then I would expect we come down towards this band of support that we've seen form. Let's talk about Apple, and we're going to talk about some more stocks in a moment as well. Last week I was talking about Apple and talking about the fact that we were below that 5-day moving average and that this prior support had the potential to act as resistance. That's in fact exactly what did happen. We were focused on the potential for it to move back to about 435 because that's where we had this prior resistance. That's where the 38.2% retracement was, and that's also about where we have that 50-day moving average. Actually, 435.13 is that green 50-day moving average. We also spoke about that would be a perfect place for it to pull back because it would potentially form an inverted head and shoulders pattern. Now, this is not a bullish pattern right here, right now. We fell off of that declining 100-day moving average. This is a stock that still, best case, is in the bottoming process. We're turning more neutral in Apple, that's all. As I said, don't buy stock because Apple said they're buying stock. I can help Apple by saying, here's when you should be buying stock, and it's not well, we have a declining 5-day moving average. Now, of course, they're playing a different game than we are. What we're looking for is the swing trades, and to be long, I think speculatively, very speculatively, I like to use the weekly call options up in here and short on these down moves and catch some of these really nice intraday moves if you can as well. But we came up to the volume weighted average price for the week and found resistance there today. If we look at the volume weighted average price year to date, that's up here at about 452. So if we continue to rally, that will be a pivotal level. But obviously we have what's turning into the neckline at about 470-ish of this potential inverted head and shoulders pattern. So maybe we'll build a right hand shoulder, the right side of that right shoulder, or maybe we'll just continue down and finish down towards 400 once again. Not finish, but head down towards 400 once again. The weekly time frame, we're still in a primary downtrend. Don't lose sight of that fact, and we have a declining 100, 150, and 200. It takes time to turn this ship around. Back to the shorter term time frames, though. Again, maybe next week this is going to be an important level at about 440. We have the declining 5-day moving average in there. If we break back below this 430-ish level, then I wouldn't be surprised at all to see it continue along that path of least resistance. So it's still early, in my opinion, to be making longer term positions in Apple. There's a lot of great trades in there that present themselves over and over again. Google has been the real star recently after those earnings. We kind of had a shakeout below that 50-day moving average. The 50-day moving average was advancing that whole time, and as it broke this resistance at about 820, we've had this phenomenal run. Now you can say that it's up too much, it's extended or whatever. We've seen these types of weekly runs before, and if you look at the way you don't want to buy after these types of moves. Instead, you want to see those pullbacks develop and buy as they're breaking higher once again. So I don't think it makes sense to be buying Apple up here. I had retweeted something Ivan Hoff had mentioned about the PE ratio and how irrelevant it is to a growth stock. And it doesn't mean that Google is cheap at this point. It means that get rid of that PE ratio in your mind when the stock is trending higher. Get rid of what you think should happen and listen to the message of the stock. Listen to the message of the market. So gold, as I said, I wouldn't be surprised. Actually, this would probably be our first downward target at about 126, 127. And if that fails to hold, there's no reason to think it would hold in a primary downtrend. That this downtrend could continue for years. And I know that a lot of people aren't going to be happy to hear that, but just like this rally held for years and then the distribution, we now are in an official stage 4 downtrend. Sellers are in control. They're in control of silver. Someone argued with me back in here saying that, the price of silver is actually in an uptrend because of what spot was doing. And I said, you're basically high. Silver is broken and it's going to continue to, if they don't scare you out on the way down, they will eventually wear you out in that. Focus on strong things like the oil service group. The oil service group, you don't have to read Senate Bill 325 HR 256 whatever. I made that up. The point is, you don't have to know about the politics of oil drilling. You look at it and say, this is a nice pattern. You call this a double-shouldered inverted head and shoulders if you want, but the fact is this 45-ish, 45.10 area has been resistance for about 2 years. It looks like it's getting ready to break out, and you look at components and say, shares of Hornbeck Offshore. These, this stock started to just get going once again. There's a lot of good-looking stocks in that group. Those are what to focus on. In even a ridiculous stock that, or a company that people like to make fun of, Microsoft, is yesterday's news. It's behaving well in here. It rallied up on increased volume. It pulled back perfectly, and then look at the intraday time frame. Look at a 30-minute. Look at how it pulled back in here and then got back above that 5-day moving average. Higher high right here, and then these higher lows. This is where it became in alignment after that pullback had revealed itself. There's been great setups in stocks like NTAP that broke some resistance 2 days ago that we were talking about it in Alpha Trends. And there still continues to be a plethora of long side setups that reveal themselves to us day in and day out. And until that slows down and there's not good candidates to trade on the upside and we're breaking support in the markets, you have to treat this market as innocent till proven guilty. By the way, I'll be out Wednesday, Thursday, and Friday of next week. So I'd like everyone to take a trial to Alpha Trends, but I wouldn't suggest you do it this weekend because you're not going to get any value out of it Wednesday, Thursday, and Friday of next week. So have a good long weekend as well, and I will talk to you when I get back. Thanks.